People ask me all the time, Warren, are you worried about a market crash? And my answer is always the same. Of course I am, but probably not for the reasons they think. I'm not worried about whether a crash will happen. I know it will. Crashes are as certain as the sunrise, and they're baked into the system. They're part of the deal when you invest in stocks. What I'm worried about is how people will react when it happens, because that's what determines whether they lose their fortune or set themselves up for generational wealth. I'm 95 years old. I've lived through more market crashes, recessions, panics, and crises than I can count. The crash of 1973 to 74, Black Monday in 1987, the dot-com bust that wiped out trillions, the 2008 financial crisis that nearly brought down the global financial system, the COVID panic of 2020 when the market dropped 34% in less than a month. And you know what I learned from every single one? The crash itself isn't what destroys wealth. It's how people respond to it. The investors who panicked and sold at the bottom, they locked in permanent losses. The investors who stayed calm, or better yet, who bought more, they made fortunes. Today, I want to talk to you about the crash that's coming. Not because I can predict when it'll happen. I can't. And anyone who tells you they can is lying or deluded. But I can tell you with absolute certainty that another big crash is coming. Maybe this year, maybe in 3 years, maybe in 10 years. It doesn't matter when. What matters is that you're prepared for it, mentally, emotionally, and financially. Let me take you through some history, because if you understand the past, you'll be much better prepared for the future. In 1973 and 74, the market dropped nearly 50%. It wasn't a quick crash and recovery. It was a grinding, demoralizing decline that lasted almost 2 years. Companies I knew were solid, wonderful businesses were trading at prices that made no sense. The news was terrible. Inflation was out of control. There was an oil crisis, Watergate, recession. People were convinced the American economy was finished. I was buying like crazy. Not because I was brave, but because I understood that the businesses hadn't changed, only the prices had. I bought shares in the Washington Post for about 1/4 of what I thought the business was worth. I bought other wonderful companies at bargain prices. Those investments became some of the best I ever made. In October 1987, the market dropped 22% in a single day. One day. People call it Black Monday. The panic was extraordinary. Trading systems were overwhelmed. People thought the financial system was collapsing. But you know what? The businesses I owned didn't lose 22% of their value overnight. Coca-Cola didn't suddenly sell 22% less soda. The panic was in the market, not in the underlying businesses. I didn't sell a single share. Within 2 years, the market had fully recovered and went on to much higher highs. The dot-com bubble that burst in 2000 was fascinating because it was so obviously irrational. Companies with no earnings, no profits, sometimes no revenue, were valued at billions of dollars. People were convinced that the internet had changed everything, that old valuation metrics didn't matter anymore, that this time was different. It wasn't different. It never is. When the bubble burst, trillions of dollars in paper wealth vanished. But the real businesses, the ones with actual earnings and cash flow, survived and thrived. Meanwhile, I was criticized during the bubble for being too conservative, for not understanding the new economy, but I slept just fine and I didn't lose money when the crash came. The 2008 financial crisis was the worst since the Great Depression. Major banks collapsed. The entire financial system was on the brink. The market dropped 55% from peak to trough. I remember the fear, the panic, the certainty that everything was falling apart. And I remember the deals we made at Berkshire Hathaway. We invested $5 billion in Goldman Sachs with very favorable terms. We invested in General Electric. We invested in Bank of America. Why? Because we had cash when everyone else was desperate for it. Because we had the temperament to act when everyone else was paralyzed by fear. Those investments made us billions, not because we were geniuses, but because we were prepared and we stayed rational when everyone else was losing their minds. Then in 2020, COVID hit. The market dropped 34% in 3 weeks. the fastest crash in history. Once again, the panic was extraordinary. People were certain the economy would be destroyed for years, maybe decades. Within 5 months, the market had fully recovered. Within a year, it was at all-time highs. The investors who sold in March 2020 locked in massive losses and missed the recovery. The investors who stayed invested or bought more did extraordinarily well. Do you see the pattern? It's always the same. The crisis is always different. The details change. But human behavior, the cycle of fear and greed, that never changes. And that's what you need to understand. So let me tell you why I'm certain another crash is coming and what it might look like. First, valuations are elevated. Not in every part of the market, but in many areas. When you're paying very high prices for assets, your margin of safety is thin. Any disappointment, any shock to the system can cause dramatic price declines. Second, there's enormous speculation in the system. Cryptocurrencies with no intrinsic value trading for hundreds of billions of dollars. Meme stocks driven by social media hype rather than fundamentals. People day trading options like it's a video game. SPACs, special purpose acquisition companies, raising billions with no actual business. This is a sign of excess of greed overwhelming common sense. Third, leverage is high. When people borrow money to invest, they create fragility. They're setting themselves up for forced selling when prices decline. Margin calls, liquidations, this is how crashes cascade and accelerate. Fourth, interest rates have been historically low for years, and now they're rising. Low rates inflated asset prices across the board. As rates normalize, valuations have to adjust. This adjustment process is rarely smooth. Fifth, and this is the big one, investor psychology is complacent. When markets have gone up for years, people forget that they can go down. They forget that crashes happen. They convince themselves that this time is different, that we've entered a new era of permanent prosperity. This is exactly when crashes happen, when everyone is confident, when fear has disappeared, when people are mortgaging their houses to buy stocks. That's when you should be most worried. Now, I can't tell you when this crash will happen. It might be triggered by a geopolitical event, a financial crisis, a pandemic, a black swan nobody saw coming. The trigger doesn't matter. What matters is that the system is set up for a crash, and crashes always come eventually. But here's what I can tell you. When it happens, the people who are prepared will be fine. The people who panic will be devastated. Let me tell you the mistakes I see people make over and over again, because these mistakes turn market crashes from temporary setbacks into permanent destruction of wealth. Mistake number one, panic selling. When the market crashes, people look at their statements, see that they've lost 30 or 40%, and they can't take it anymore. They sell everything, swearing they'll get back in when things calm down, but they never do. Because by the time things calm down, the market has already recovered. They sell at the bottom and miss the recovery. They lock in their losses. This is the single biggest wealth destroyer I've ever seen. Mistake number two, trying to time the market. People think they can predict when crashes will happen and when recoveries will begin. They think they can get out at the top and get back in at the bottom. I've been investing for over 80 years, and I've never successfully timed the market. Charlie Munger never timed the market. I don't know anyone who's consistently timed the market. It's a fool's game. Mistake number three, following media hype and panic. Financial media makes money by getting your attention. Fear and panic get attention. So during crashes, they amplify every scary headline, every worst case scenario. They're not trying to help you. They're trying to get clicks and viewers. If you make investment decisions based on what you see on financial television, you will lose money. I guarantee it. Mistake number four, overconfidence during good times. When markets are going up, people think they're geniuses. They start trading more, taking bigger risks, using leverage. They forget that bull markets don't last forever. Then when the crash comes, they're caught completely off guard. The leverage destroys them. The risky bets blow up. The overconfidence turns to panic. Mistake number five, forgetting that investing is about businesses, not ticker symbols. When you buy a stock, you're buying a piece of a business. If that business is fundamentally sound, temporary price declines don't matter. But most people don't think this way. They see their portfolio value dropping and they panic without asking whether the underlying businesses have actually changed. Here's a quote I love. Wall Street makes money on activity. You make money on inactivity. The more you trade, the more you react, the more you try to do something during crashes, the more money you lose. The investors who make money are the ones who do nothing, who hold their quality businesses through the panic. So what do I do when crashes happen? Let me walk you through my strategy because it's simple and it works. First, I keep significant cash reserves. Berkshire Hathaway always has $20 billion or more in cash and short-term treasury bills. People criticize this, saying we're not putting our money to work. But that cash is a call option on opportunity. When crashes happen and prices get attractive, we have the ability to act. We're not forced sellers. We're opportunistic buyers.
For an individual investor, this means keeping at least 6 to 12 months of living expenses in cash or cash equivalents. If you're retired, maybe 1 to 2 years.
This buffer means you never have to sell stocks at the wrong time. Second, I only own businesses I'd be comfortable holding through a 50% decline.
If the thought of your portfolio dropping 50% would cause you to panic and sell, you're invested too aggressively. You need to dial back your risk until you can sleep at night.
I can hold through any decline because I own businesses I understand, businesses with durable competitive advantages, businesses run by people I trust. When prices drop, I know it's temporary. The businesses are still sound. Third, I never use leverage. Never. Leverage is how most fortunes are lost. When you borrow money to invest, you create the possibility of forced selling at exactly the wrong time. You lose control. A temporary decline becomes a permanent loss. If you're using margin or borrowed money to invest, stop immediately. Get out of that position. Sleep at night. Money should never be leveraged. Fourth, I ignore the noise. I don't watch financial television. I don't obsess over daily market movements. I don't read panic headlines. I focus on businesses and fundamentals, not on what Mr. Market is feeling today. Fifth, I view crashes as opportunities. When others are panicking, when quality businesses are selling at 50 or 60 cents on the dollar, that's when I get excited. That's when I buy. Let me give you concrete examples. In the 1,970 seconds, I bought the Washington Post for a fraction of its intrinsic value because everyone was scared. In 1976, I bought Geico when it was nearly bankrupt and everyone thought it would fail. In 2008, I made some of the best deals of my career because we had cash and courage when everyone else had neither. In each case, I wasn't doing anything clever. I was simply buying good businesses at attractive prices when everyone else was too scared to act. That's the whole secret. Let me explain something that most investors never understand. Cash is a call option on opportunity. When you hold cash during good times, it feels like you're losing. The stock market is going up and your cash is just sitting there earning almost nothing. People criticize you for being too conservative, for missing out. But cash gives you flexibility. It gives you the ability to act when opportunities arise. And the best opportunities always arise when everyone else is panicked and desperate for cash. This is what I mean when I say, be fearful when others are greedy and greedy when others are fearful. When everyone is euphoric and buying everything, that's when you should be cautious, building up cash reserves. When everyone is terrified and selling everything, that's when you should be deploying that cash into quality businesses at attractive prices. This requires patience, enormous patience. Sometimes you hold cash for years waiting for the right opportunity. That's hard psychologically because you watch others making money in the bull market and you feel like you're falling behind. But then the crash comes and suddenly your patience is rewarded. The businesses you've been watching, the ones you've always wanted to own but were too expensive, they're now available at 50 or 60% discounts. You deploy your cash. You buy quality at bargain prices. And over the next decade, those investments make you wealthy. This is why I say our favorite holding period is forever. We're not trying to flip stocks for quick profits. We're trying to own wonderful businesses and hold them through multiple market cycles, through multiple crashes and recoveries. Time is the friend of the wonderful business and the enemy of the mediocre. If you own quality and you're patient, time does all the heavy lifting for you. Now let me talk about capital protection, because this is where most people fail. I've said it 1,000 times. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. People think I'm joking or being clever. I'm not. I'm being absolutely serious. When you lose money, especially significant amounts, the math of recovery is brutal. If you lose 20%, you need a 25% gain to break even. If you lose 33%, you need a 50% gain. If you lose 50%, you need a 100% gain. If you lose 75%, you need a 300% gain. This is why avoiding big losses is more important than capturing big gains. One big loss can wipe out years of gains. It can destroy your compounding. It can devastate your retirement. So how do you protect capital? Through 3 key concepts that I learned from my teacher, Ben Graham. First, margin of safety. Never pay full price for anything. Always insist on a discount, a buffer, a cushion that protects you if you're wrong. If you think a business is worth $100, wait until you can buy it for $60 or $70. That 30 to 40% discount is your margin of safety. Second circle of competence. Only invest in things you understand. Stay within your area of knowledge and expertise. If you don't understand how a business makes money, don't invest in it. I made billions following this rule, and I've avoided billions in losses by admitting when something is outside my circle. Third, intelligent diversification. You don't need to own 100 different stocks. That's just a way to guarantee mediocre returns. But you also shouldn't have everything in 1 or 2 positions. Owning 5 to 15 quality businesses you understand that gives you diversification without dilution. For most people, a low-cost S&P 500 index fund provides instant diversification across 500 of America's best companies. That's plenty of diversification. The key is structuring your investments so that even if everything goes wrong, even if we have the worst crash in history, you're uncomfortable but not destroyed. You can ride it out without panic selling. Let me talk about something that's more important than intelligence, more important than education, more important than almost anything else in investing: temperament. Investing is not a test of intelligence. It's a test of temperament. The ability to stay calm when everyone else is panicking, the ability to think independently when the crowd is going the other way, the ability to be patient when everyone wants instant results. That's what separates successful investors from everyone else. I've seen brilliant people, PhD economists, Wall Street professionals, fail spectacularly at investing. Why? Because they couldn't control their emotions. They panicked during crashes. They got greedy during bubbles. They followed the herd instead of thinking for themselves. Let me explain a concept that Ben Graham taught me, Mr. Market. Imagine the stock market as a business partner named Mr. Market. Every day, Mr. Market offers to buy your share of the business or sell you more of his share. Some days, Mr. Market is optimistic and offers you high prices. Other days, he's pessimistic and offers you low prices. He's manic depressive. His moods swing wildly from euphoria to despair. The key insight is this: you don't have to accept Mr. Market's offers. You can just ignore him. You can wait for days when his price is attractive and buy, or when his price is absurdly high and sell. But you're never obligated to do anything. Most investors do the opposite. They let Mr. Market's moods dictate their actions. When he's euphoric and prices are high, they get excited and buy. When he's depressed and prices are low, they get scared and sell. They do exactly the wrong thing at exactly the wrong time. If you can train yourself to ignore Mr. Market's moods, to think independently about what businesses are actually worth, to buy when others are scared and hold when others are panicking, you'll do extraordinarily well. But this requires psychological discipline that most people don't have. It requires you to go against every instinct, every emotion, every social pressure. It requires you to stand alone when everyone thinks you're crazy. That's why I say you don't need a high IQ to be a successful investor. You need emotional intelligence. You need self-control. You need the ability to override your instincts and think rationally when everyone else is losing their minds. All right, let me give you a practical checklist, concrete steps you can take right now to prepare for the crash that's coming. Step 1, build a cash reserve of 6 to 12 months of living expenses. If you're retired, make it 1 to 2 years. This money should be in a savings account or money market fund, immediately accessible. This buffer means you never have to sell stocks at the wrong time. Step 2, eliminate all leverage and margin. If you've borrowed money to invest, pay it back immediately. If you're using margin in your brokerage account, get out of those positions. Leverage is financial cancer. It will destroy you during crashes. Step 3, evaluate every position in your portfolio and ask yourself, would I be comfortable holding this through a 50% decline? If the answer is no, you need to sell it or reduce your position. You should only own things you'd be happy to hold for 5 or 10 years, regardless of price fluctuations. Step 4, make sure you're properly diversified. If you have more than 20 or 30% of your wealth in a single stock, that's too concentrated for most people. Consider moving some into an S&P 500 index fund for broader diversification. Step 5, set up automatic investments if you're still working and accumulating wealth. Set up automatic monthly purchases of index funds. This dollar cost averaging means you'll buy more shares when prices are low and fewer when prices are high. You'll be buying during the crash without having to think about it. Step 6, turn off financial news. Seriously, stop watching it. Stop reading panic headlines. They're designed to scare you and make you act emotionally. Get your information from annual reports, from studying businesses, not from television talking heads. Step 7, make a commitment to yourself right now. When the crash comes, you will not panic sell. Write this down. Tell someone. Make it a promise you can't break. Because in the moment, when you see your portfolio down 40%, every instinct will tell you to sell. You need to have made the decision in advance to hold or even buy more. These 7 steps will put you in a position where the next crash, whenever it comes, is an opportunity rather than a disaster. So let me wrap this up with my final warning and with some words of hope. The crash is coming. Maybe next month, maybe next year, maybe in 5 years. I don't know when. But it's coming. Crashes always come. It's part of the cycle. It's the price of admission for the higher returns that stocks provide over time. The question isn't whether there will be a crash. The question is, will you be ready for it? Will you panic and sell at the bottom, destroying your wealth? Or will you stay calm, hold your quality businesses, maybe even buy more, and set yourself up for the recovery? This is the choice that will determine your financial future. And you need to make the decision now before the crash, because in the moment, you won't be thinking clearly. Fear will overwhelm you. The headlines will terrify you. Everyone around you will be panicking. That's why preparation is so important. That's why building cash reserves matters. That's why only owning businesses you understand matters. That's why emotional discipline matters. But here's my message of hope. If you follow the principles I've laid out today, you'll be fine. Not just fine, you'll prosper. Because crashes, as terrible as they feel in the moment, create the greatest wealth-building opportunities of a lifetime. Every single one of my best investments was made during or shortly after a crash. Geico, the Washington Post, my early stock purchases in the 1,970 seconds, Coca-Cola after the 1987 crash, Goldman Sachs and General Electric during the 2008 crisis. These investments made billions, not in spite of the crashes, but because of them. The same opportunity will be available to you. When everyone else is selling in panic, when quality businesses are trading at 50 or 60 cents on the dollar, when fear is at its peak, that's when you'll have the chance to buy. And if you have the cash and the courage to act, those investments will change your life. So don't fear the crash, prepare for it, respect it, but also see it for what it really is. A temporary repricing, a moment when quality businesses go on sale, a transfer of wealth from the impatient to the patient. Remember, the stock market is a device for transferring money from the impatient to the patient. Crashes accelerate this transfer. The people who can't wait, who need to see gains immediately, who panic at the first sign of trouble, they sell at the bottom. And the people with patience, discipline, and cash, they buy at the bottom. Which side of that transfer do you want to be on? I've been on the patient side for 80 years. It's made me one of the wealthiest people in the world. Not because I'm smarter than everyone else, but because I'm more patient. Because I understand that wealth is built over decades, not days. Because I know that crashes are temporary, but quality businesses are permanent. You only find out who's swimming naked when the tide goes out. The crash will reveal who was taking excessive risks, who was using too much leverage, who was speculating instead of investing. Don't be one of those people. Be the person who's prepared. Be the person who stays calm. Be the person who sees opportunity when everyone else sees disaster. That's my final warning and my final piece of advice. The crash is coming, but if you're prepared, it's not something to fear, it's something to welcome, because it's your chance to build real, lasting wealth. Thank you for your time today. Now go prepare yourself mentally, emotionally, and financially for what's ahead. And remember, never lose money, never forget that rule, and never interrupt compounding unnecessarily. The crash is coming. Be ready. Good luck to all of you.